Welcome back.
Thanks. Great to be back, Rob.
Yeah, well, I'm glad to have you because listeners should know that we're recording this podcast on October 1st, which is the start of Golden Week in China. I think for most investors, it was actually this past week that was the Golden Week for Chinese equities because stocks are up something like 20% over the past few days on the back of a raft of stimulus measures announced by the Chinese government. I think pretty clearly aimed at driving consumption, supporting the housing market, and the stock market too. And so, Peter, I know that we are bottom-up investors, but I do want you to put your macro hat on to start. Can you zoom out and just maybe over the past few years, give us some broader context around this most recent stimulus and why now?
Sure. Like you said, this was a very significant stimulus a series of stimulus measures that came out of China over the last week of September. And like you said, supporting the areas that had been particularly weak in the property market, stock market, and household consumption. In aggregate, we estimate it's about 3% of GDP, and they said they're willing to do more. So the backdrop, like you said, was a very weak economy for the last couple of years. And the government had taken a number of actions that was further stifling economic activity, depressing sentiment, depressing business activity, and trying to achieve non-economic goals. But really, I think they realize maybe perhaps they've gone too far, and it's time to reverse course a bit. That certainly seems to be the message. We'll see if this is continued. But why now? I think a big part of it is with the Fed easing. Now, the Fed starting their cutting cycle, it gives room for China to also be easing and injecting liquidity without having to worry too much about a major depreciation of their currency, which would have its own disruptions for the economy.
Okay. And you started with just some of the longer term headwinds that are facing China versus, the stimulus, which obviously in the very short term has had a pretty big impulse. How do you weigh those two things? I can imagine there's a case on both sides.
Sure, definitely. I think we shouldn't underestimate the stimulus, though. Despite the challenges that the economy faces, this could be. We may look back at this and think of it as a whatever it takes moment. When Mario Draghi said that to put a line under the European sovereign debt crisis back in 2012. It also reminds me of the COVID approach in China. As you know, they had a very strict zero COVID approach for 3 years. And when it wasn't working, one day they just very abruptly opened up. So it seems that could be the case here. But like you said, it doesn't solve everything. There are still significant long-term challenges. But we think it probably helps mitigate the three of the big challenges that we see. The first of those is the weak sentiment among consumers and investors, and that can lead to a reinforcing downward spiral where the negative sentiment drives negative economic activity, etc. So if they can put a line under that, boost some confidence and boost some spending, that would help. The second one being the regulatory interference in business. When we talk to business people doing business in China, this is their number one complaint, dealing with regulations that change frequently, that are not enforced consistently, and it's just a very difficult environment in which to do business. So if the government is in fact more focused on driving economic growth, they know that business and markets are an important part of that, and they do understand that. And if they take more, business-friendly policies, that would be a significant shift. And then the third big risk, that headwind facing China, is the geopolitical risks. Now, certainly those don't entirely go away. A lot of the trade tensions, the trade war, economic war that we see between China and the West are continuing around semiconductors, around tariffs. The stimulus does not address that. But if the government is more focused on, again, economic growth, we think the odds of a significant worst case scenario for the economy, which would be an invasion of Taiwan, we think that is reduced or at least pushed much further out into the future while the government focuses on economic growth. So again, it doesn't solve all of the underlying issues, but I think moves the needle probably on three of those big risks.
That last one is most fascinating. Can you help me connect, though, these perspectives? And it does sound like you think the stimulus is quite significant, not just a shorter term impulse. How does that macro lens enter into the work that you and the team does in managing the emerging markets portfolio. So for example, listeners would know that over the last couple of years, we had been reducing our position in Chinese companies. And I'm just wondering if you can tie just how much of that was macro driven or risk driven versus the bottom up, or are they quite intertwined?
Definitely, to your question, they are very intertwined from our view. We are bottom up investors. And as part of that bottom up fundamental analysis that we do, the macro awareness is very important. So that when we analyze and incorporate macro risks into our company specific analysis, that shows up in our DCF models, in the projected growth rates, in the discount rates. And when our perception of those risks shifts, our assumptions or the ranges where we use around those variables shifts as well. And as you said, this approach has led to our perception of heightened risk in the last few years and a reduction in our Chinese holdings. But we were also increasing our positions on the day the stimulus was announced in late September, as we think the odds have shifted. So incorporating some of those macro views into the bottom-up analysis and reflecting that risk-reward assessment in the portfolio decisions.
Well, I just wonder, can you make it a bit more real in the sense that can we talk about a specific company or set of companies and just, how that bottom up actually works in the context of a risk framework?
Sure. So when we assess that the risks are higher, we apply a higher discount rate in China and essentially requiring a higher hurdle, a higher rate of return to compensate us for those risks. And that's across the board for all of our investments in China. And therefore, the ones in the portfolio are the ones where valuations are most attractive and where they meet that higher hurdle rate. And the second issue is on the growth rates for those companies which we deem are more economically sensitive in a very weak macro environment. We've brought down some of those projected growth rates. So companies like Milky Way Chemical or Great River Logistics, which are in more cyclical industries, doing chemicals distribution tied to industrial activity. We brought down our long-term expected growth rates there, given the structural challenges in the Chinese economy. Again, not looking at quarter to quarter, but over a 5-10 year view. And we think the outlook had weakened. So when we think about the ranges, the possible rates of growth that those companies could achieve over the long term, those came down. And they were no longer attractive enough. The valuations were no longer attractive enough with those combination of the lower growth rates and the higher hurdle rates to be in the portfolio. So those were some of the examples of the stocks that we exited. On the flip side, there are other companies, and we're specifically emphasizing the ones that we think have independent growth drivers, independent of the overall economy. No company is entirely independent, but ones with less reliance. So companies that can continue to do well in an environment where, yes, there are headwinds, but maybe we think the Chinese economy is more likely to look like a stone rolling down a hill rather than that risk of just really falling off a cliff. And in that environment, there's a lot of companies that have their own growth initiatives that can do well, even in a weaker backdrop.
And do you have a couple of examples of those?
Sure. Certainly Tencent is a great one to highlight. They have a very prudent management team, very world-class, and they're focused on providing the best experience to their customers in their apps. And as a result, they've been able to achieve and maintain a very dominant position with their WeChat app. But along the way, they've been very conservative on monetization because they want to protect that consumer experience. So now they have an opportunity to pull some of those levers to increase monetization, to improve their ad revenue, and continuing to grow profits, even if the overall advertising spending is weak and the overall economy is weak. So they have their own monetization levers that they can pull. And we think the valuation is still very attractive, despite being a huge, well-known company, because of all of the pessimism toward China. Another example is Tencent Music. This is the Spotify of China. It's a listed subsidiary of Tencent, so shares that great DNA, the great management culture. And similarly, they've been focused on achieving the dominant market position in online music streaming. And they have not, pulled those monetization levers as much as they could have. So now there's an opportunity for them to do that going forward with more advertising and higher pricing.
Peter, we've talked a lot about the impacts of the stimulus in China specifically, but I wonder within the broader emerging markets universe whether there are ripple effects associated with this, or is this really primarily focused domestically? And I guess as an example, I'm thinking about Indian companies, which may have benefited over the last couple of years as the West has sought to diversify supply chains. Might that reverse off these latest stimulus measures?
I think because of the long-term structural issues that China still faces, I don't think it changes the decisions that companies will be making around diversifying supply chains. Vietnam, for example, is a big beneficiary. You could see more in the short term, from an investor fund flows perspective, where investors may have been selling Chinese stocks and buying Indian ones, and that could reverse. But for us as fundamental long-term investors, I don't think it dramatically changes the outlook for most other countries and companies outside of China.
Perfect. Shifting gears, your portfolio, the emerging markets portfolio, has had a pretty great year so far. How come? What's been going well?
Well, our performance has been driven by stock selection this year. We talk about macro awareness, but ultimately our goal is to find great companies that can create shareholder value and investing in those companies for the long term. So some of the biggest contributors to the portfolio this year have been FPT, which is a Vietnamese IT company, IGS, which is a Taiwanese mobile games company, and Aegis Logistics, which does logistics for LPG fuel in India. And the common theme here is I call them stealth performers. They're not household names, but they're just excellent businesses run by great management teams, somewhat flying under the radar. And every day they are creating value for shareholders day in and day out.
And I know you're quite a fan, Peter, of ensuring that you have the ability to add stealth performers to your portfolio. And what I mean by that is yours is a genuinely all cap portfolio with meaningful representation from the small and mid cap segments. Anything that you found there that you've added to the portfolio over the last year that you think is worth sharing?
Well, I think one to highlight would be Beam in Turkey. This is a discount retailer. And again, that kind of go anywhere approach, looking at all market caps, all geographies. Turkey's been an unloved, overlooked market for many years, including by us, because the economic risks were so high, inflation was so high, that the discount rates that we use in our DCF models are so high that it was very difficult for any company to meet that hurdle. But when on our team took a visit to Turkey last year, he met with a number of companies, including the management of Beam, did some store visits. And this is a food retailer. They focus on discount retail. The backdrop has also markedly improved because Turkey, although they still have economic challenges and very high inflation rates, they've shifted to a more orthodox, conventional approach focused on helping the economy and bringing inflation down. So the outlook is much better than the tough period that they've had over the last 7 or 8 years. And Beam in particular, one of the insights we had there was, as a hard discounter, it's a very efficient model. They're very good operators. They have extremely low prices because of their model and effective management. So while many of their competitors, other food retailers, have been struggling in this tough economic environment with high inflation, Beam has actually been gaining market share because they're able to offer that value proposition, the low prices to consumers, and they've been growing and doing very well, even in a tough period. So as the environment normalizes, as the economic outlook improves in Turkey, BIM is coming at it from a position of strength, and we see a very positive long-term outlook for that company.
Can I ask just, speaking of Turkey, inflation, you mentioned it, it's something that comes to mind. And this maybe goes back to an earlier part of the conversation, just about how the bottom-up work that we do marries with some of the risk assessment. How does that lira devaluation enter into the consideration with Beam?
So one thing that's very important in our analysis of any company, and especially in these companies operating in high inflationary environments, is their pricing power. And with BIM, they have been able to fully pass through inflation. We're talking inflation rates as high as 40, 50, even up to 70% in some months, annual inflation. And BIM has been able to pass those on in the form of higher food prices and still take share. So when we look at their revenues and profits in US dollar terms to strip out that lira depreciation, they continue to grow at very healthy rates, generate good profitability, And so thanks to their pricing power and that strong position that they have.
Fantastic. Well, Peter, thank you for the tour. Mainly China focused, but we did manage to get to other parts of the world. Appreciate your thoughts and all the work that you and the team do on the emerging markets portfolio. Thank you.
Thanks for having me.